You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 3rd of January 2026, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing British American Tobacco, Moonpig, Carnival, Hollywood Bowl, Currys, and our US listed company of the week is Wix. John, do you want to start us off with British American Tobacco, a stock we just sold in our fancy portfolio, actually?
Yeah, we'll kick off with British American. So for anyone who doesn't know, it's the largest tobacco company in the UK, and it's the 6th largest company listed on the FTSE 100. We've covered it quite a few times, and as Sam says, it was in the fantasy portfolio as one of your picks, and we have recently sold it in the fantasy portfolio. So in terms of the results out, it was a full year trading statement, and they expect full year revenue growth of around 2% before currency impacts, and in line with previous guidance. There's been a mid-single digit revenue growth from new categories, which is essentially their vapes and smokeless division, reflecting an acceleration in the second half. Underlying operating profit is expected to grow at a similar pace to revenue, and the company is expecting an improvement in 2026, both with sales and underlying operating profit growth to land at the bottom of the respective 3 to 5% range and between 4 and 6% in terms of medium-term goals. Net debt is expected to fall back within the target range, and a £1.3 billion share buyback for 2026 was also announced, and the shares were down around 4% in early trading. In terms of valuation, British American Tobacco has a market cap of £91 billion and trades at 11.9 times forward earnings, compared with a 10-year average of 10.5, and it has a prospective dividend yield of 5.8%. I thought this was, largely as we've come to expect. I would say over the last year, 18 months, what we've seen with British American is that in the traditional sort of combustibles division, the falling of the volumes has largely stabilised and is now in the lower single digits. What we did see a couple of years ago was that volumes were falling in the combustibles divisions by higher single digits. And I think if you were to make an investment case for the company, ethical concerns aside, it would have been more difficult to make that on the basis that where their largest source of revenue and profitability was coming from was clearly in structural decline and falling at a faster rate than it had done. For whatever reason, that seems to have now sort of moderated and you're back to the low single digits. They seem to be able to offset that largely on the basis of price rises. When it comes to their new categories, again, growth there has moderated. They have become profitable, and I guess that is a case, if you were to make it, that whilst the traditional business is in structural decline, there is a future ahead in the sense that they've got a business that is still growing and that may be sort of more sustainable. I think one of the other comments is that since starting the podcast getting on for sort of 5.5 years ago, you have seen a massive re-rating in terms of the shares, and it was almost priced to go bust. And at 11.9 times forward earnings, it's getting closer to the sort of historical average. I think if we go back over, probably the last 10 years, I can remember relatively shortly after they bought Reynolds that I think it got as high as 17 times earnings. It was really, much, much more expensive. But compared with probably 5 years ago, we got to a lot of the institutions selling off, and the shares were down to maybe the low 20s, something like that. And the dividend had gone up. It was definitely high single digits back then. So I think we've seen a lot of, a re-rating, and possibly, again, when we had low interest rates and you had a lot of the tech stocks sort of going to the moon, particularly 2021, That was really when these shares were in the doldrums. And actually now, I think you've seen that resilience in the earnings, combustibles decline moderating, and you've had that re-rating. And probably the dependability of the earnings is something that investors are considering too. My view would probably be now that British American is probably fully valued and everything has been taken into account. The debt is still on the higher side, between 2 and 2.5 times EBITDA. And the other thing I think I would consider is you're only getting 5.8% yield now. In a world of higher interest rates, you can get a decent income by, gilts or, government bonds. And that's essentially risk-free. So for 5.8%, yes, that's a bit higher. I'm not sure that would be worth it, even ethical concerns aside, with this stock. So it wouldn't be one that I would be looking at and thinking that looks great value anymore, even if you sort of discount the ethical side. So not one for me, Sam. What are your thoughts on these results?
I'd largely agree. I think in terms of that valuation, I think I've got a figure in my head, I think it got as low as a P of kind of 6. And then the dividend yield was, I don't know if it quite hit 10%, but it was certainly approaching
Close.
10%. It was high 9s, I think. So yeah, I think in terms of the results, they're okay, but I think 2% is probably a bit lower than we've been used to.
Yeah.
The categories kind of dropped off. I just think for what you're actually paying now, forward P of 12, yield of 5.8%, yeah, it's pretty decent, but you can go and get that elsewhere now. Whereas you go back 2-3 years ago, you couldn't get a 10% dividend anywhere else that was actually well covered.
Yeah.
You might be able to get a 10% dividend, but it was probably 10% because everyone was expecting it to be cut.
Yeah.
Whereas that was never really a danger for British American or Imperial. So I just think now, if you want a 5.8% yield, why don't you just go and get it in a REIT or something like that? There are other options now, and you don't need a business that is in potentially structural decline, although I think that argument's kind of gone away a bit more with the non-combustibles. It's not a terrible business. I think if it dropped back down, I mean, I used to have shares in it. I think if it dropped back down to a P of kind of 6, dividend yield of 10 again, I'd probably be quite interested in owning it again. But the current price, I think the opportunity cost just isn't, it's just too high.
Yeah, I think the other thing that's worth mentioning as well, that obviously governments put taxes on tobacco and are going to be on the non-combustibles as well. With those taxes being so high, I think it is driving illicit sales, which of both combustibles and non-combustibles. And I think that is something also to consider, because as those keep going up, and I think they're quite popular taxes, you are seeing the price of the legitimate sales going up and up and up, and growing illicit sales. So that obviously hits companies like British American, and I know people wouldn't have any sympathy for that, but I think quite, purely from a numbers point of view, it is a worry for the business.
I suppose, I guess on the flip side, at least with the taxes now coming in for the non-combustibles, that might level it out a bit. But when you look at what the liquids will be with the tax for the e-cigarettes, they're still incredibly cheap compared to like a 20-pack of Marlboros.
Yeah.
Marlboro's not a British American brand anyway, but you get the idea. Should we move on to Moonpig, a company that may actually be more of a goer than we thought when we first covered it?
Yes. How are Moonpig doing, Sam?
They're doing pretty well. So Moonpig, the online card company, for anyone who's not familiar, we have covered them before. We also recently covered their main rival, Card Factory, who own Funky Pigeon. So Moonpig have come out with their half-year results for the 6 months ended 31 October 2025. Revenue was up 6.7% to 168 million. Gross profit was up 3.7%, and there's now a gross profit margin of 57.6, which is actually down 1.6 percentage points. Adjusted EBITDA was up 7.7% to 45 million, and that gives us adjusted EBITDA margin of 26.7%, which is up slightly, 0.2 percentage points. Profit before tax was up 180%. Adjusted profit before tax was up 11.4%. Reported earnings per share was up 154%, and adjusted earnings per share was up 13.1%. Dividend per share, that was up 25%, and They also repurchased £30 million of shares during the year, which is, I think, the first time they've done it since they're listed. And for context, that's on a market cap of 630 million. So it's not an insignificant sum, that. It's about 4% of the share count they've repurchased, and that's on top of, we'll cover it later, but they are paying a dividend as well. The Moonpig brand revenue grew at 9.4%, and Greets returned to growth at 1.3% in constant currency and 3% on a reported basis. So Greets, that's basically the Moonpig of the Netherlands, which they also own. Their experiences side of the business decreased 8.9% year on year in the first half. However, they've said recent trading has been encouraging with improved performance in the second half to date. Active customers increased from 11.7 to 12.1 million, with growth in both Moonpig and Greets. They've seen continued momentum in the gift attach rate, which increased to 17.8%, and that's up from 17.3% a year ago. And they've said the database of customer occasion reminders grew to 107 million, and that's up from 96 million a year ago. And the use of creative features, including AI-generated stickers, audio or video messages, and personalised handwriting increased by 57% year on year. Moonpig Plus and Greeks Plus subscriptions increased to 1.02 million members, and that's up from 0.75 million a year ago. Share buyback of 30 million was completed, and there's an intention to repurchase up to 60 million during the year. So that could be half of what they actually end up buying back. The CEO, Nicole Rathatha, has said as part of their comments, more than 50% of subscribers are now using their innovative creative features to make their cards more personal. So that's stuff like the AI stickers that we mentioned earlier and personalised handwriting. So if we go by division, as mentioned, Moonpig was up 9.4%, and they saw increases in both number of orders and average order value. Revenue in new markets, Ireland, Australia, and the US grew by 32.3% year on year. Greeks was up 1.3% constant currency, and experiences was down 8.9% as they continue to execute the repositioning supported by new commercial leadership, improved online user experience, and the rollout of new partners such as Pizza Express, the Traitors Live experience, Sixes, and Spotify subscriptions. While these improvements were not reflected in half one revenue, performance has improved in the second half to date. So it does sound like there's genuinely been a bit of a rejig with that. From that, I'd interpret the experiences to genuinely be a temporary blip, because I think that is surprising otherwise. So yeah, I think the experiences drop is disappointing, but given what we've seen from them in the last few years, what they've said there and what it seems like the second half's going to look like, I'd be inclined to give them the benefit of the doubt on the experiences. And you'd hope with some of these partnerships, which do sound quite promising and actually sound like probably better gifts than maybe some of the stuff that was on there previously, I think it does sound like experiences is probably well positioned for the future. I think as well, just as an aside, it's anecdotal, but like I went in Card Factory over the Christmas period and I was really not impressed with it. I actually struggled to find a card that was actually I liked. It was one for my girlfriend. I thought the range of girlfriend cards was actually quite limited. There was a lot more wife ones, but I ended up getting a card for special friend instead because I just didn't like any of the girlfriend ones. I know they've got Funky Pigeon, but if I'd gone on Moonpig and just done it online, although I'd have had to have done it a bit sooner, but if I'd done it online, I wouldn't have had that issue because with all the personalised ones, I'd have been able to do something much better. I think of the two, I do prefer Moonpig, although when we looked at Card Factory, it was surprisingly decent. In terms of the price, the adjusted PE is 13.5 and the reported PE is 15.2. And the yield is 1.5%, but as mentioned, they are starting to quite aggressively buy back shares. So yeah, I think probably still not quite for me, but I think you could do a lot worse than Moonpig. I think it's a good business, and I think these results in the round are pretty good, experiences aside. What about you, John?
Yeah, I think the experience is the thing that, for me, was most surprising. And it's also, guess where there was a huge margin. And I think that was probably the most exciting part of the business before. So I'd be a little bit wary. I appreciate what they're saying about the guidance, but for that reason, I probably wouldn't dive in. That's the thing that makes me a little bit anxious. I wonder whether on that side of the business, maybe there's a bit more cyclicality, and in a difficult sort of consumer environment, whether that's where people are cutting back and they're not adding those extras. I think margins otherwise very impressive, and it's got about 70% of the UK market share. It seems quite sticky. So I think it probably is a good business, but that would just make a little bit more wary. So not for me right now.
if we were to come back in 6 months and experience this has rebounded like this said, all these new partnerships are bombing away, would it be one that you'd consider for your watch list?
I think it probably would be, actually.
That's interesting. Because I think when we first covered it, it's kind of a company I never would have imagined actually being a watch list stock.
Yeah.
But it's surprising. So should we move on to a company that's also not on the watch list?
Yes, no, absolutely. So it's Carnival. We have covered it before, but it is a decent-sized FTSE 100 stock, so I think we do need to cover it. It's the largest cruise company in the world, with some of the most famous brands like Cunard's, P&O, and Carnival itself. It had its Q4 results out last week, with full-year revenue increasing by 6.4% to $26.6 billion, driven by growth in both ticket sales and onboard revenue growth. Underlying cash profit, EBITDA, grew by 17.5% to a record $7.2 billion, helped by disciplined cost management. And strong demand for last-minute sailings in the final quarter contributed to a small beat on guidance. Free cash flow more than doubled to $2.6 billion, largely due to reduction in capital expenditure. And year-end net debt was $24.7 billion. The company reinstated dividends with an initial quarterly payment of 15 cents a share, and underlying cash profit for 2026 is expected to increase to around $7.4 billion. Carnival proposed an overhaul of its corporate structure, which likely includes moving to a single listing on the New York Stock Exchange, which is interesting. And the shares were up around 8% in early trading. In terms of valuation, Carnival has a market cap of £29 billion and trades at 1.2 times forward price to sales, compared with a 10-year average of 1.27. I thought these results were good, and I think management are doing an excellent job. Everything seems to be going in the right direction. I think the main thing, and it doesn't come as a surprise because we have been covering Carnival for the last few years, is the cruise industry was probably the worst hit by COVID, and it was the slowest to recover from COVID. Essentially, it was just ground to a complete halt. And a lot of that $24.7 billion of debt was essentially happened over that period. It's around 3.3 times EBITDA, which is the lowest it's been for some time, and it is falling. My view, though, with management, whilst they do seem to be doing a good job, is that they shouldn't be restarting a dividend when the debt is that high. I think the main thing for me is that it's such a difficult industry. It was a difficult industry before COVID, requires a huge amount of capital expenditure, and it's still got all those scars from COVID with that debt burden. I just wouldn't go near it. I don't think there are many other cruise companies around. It's a very difficult industry, and if you want to play on the cruise industry, I guess this is it. And some people perhaps would be attracted to it by the fact that they do seem to be doing well, and that it's obviously a very cheap stock. I would argue that is for good reason, but perhaps you could see, an investment case on that basis. And if you are bullish on, the cruise industry continuing and also continuing to recover, but with net debt like that and the capital expenditure that's required going forward, I wouldn't be going near it. But I think, dividend aside, management do seem to be doing a good job here. Sam, what are your thoughts on Carnival?
Pretty similar. I suppose once it's moved to the US, which I don't see as a great loss, but again, it's just that pattern of companies leaving the UK. I guess with it being dual listed to start with, it was kind of always more at risk in any case. But once it's moved to the US anyway, I suppose for US investors, they will have a bit more choice because they've got Royal Caribbean over there, but on the FTSE, there's nothing else. And soon there'll be nothing. So I don't think it's a huge loss, that being said. But yeah, I think the decision to pay a dividend, I think that's a bit odd. There's a huge difference between the EBITDA and free cash flow. It's pretty obvious why. It's the interest, because the EBITDA obviously is before the interest. And yeah, because I think that year-end net debt at 3 times EBITDA, it doesn't look horrendous initially, but then once you factor that interest in and it drops to 2.6 billion free cash flow, year-end net debt is nearly 10 times that. which is huge. I think they've done quite well managing COVID, or as well as they could have done. But yeah, I just think, why are you restarting the dividend? Just try and I keep chipping away at that debt personally, but management like paying dividends. So shall we move on to Hollywood Bowl?
Yes. How are they doing?
Very well. So again, I think not dissimilar to Moonpig, probably another business that's maybe been surprisingly better than we would have expected. So Hollywood Bowl, I'm sure most people are familiar with them. If you've ever been to a children's birthday party in the 2000s, they are the bowling lane company. So Hollywood Bowl, they have come out with their full year results for the year ended 30 September 2025. And revenue was up 8.8% to 250 million. EBITDA was up 4.2% to 91.2 million. Profit before tax was up 3.6% to 44.3 million, although for the adjusted results, it was down 8.6%. Earnings per share, that was up 16.4% on statutory and down 1.9% on adjusted. And the total ordinary dividend per share was up 10.1%. It's the fourth consecutive year of record revenue and adjusted EBITDA in line with expectations. UK like-for-like was up 1.1% despite a challenging backdrop for indoor leisure, with spend per game up 9.2%. Canada like-for-like was up 3.2% on a constant currency basis, with spend per game up 14.8%, and strong value credentials have been maintained. A family of four can bowl in the UK for £26. The dividend policy has been updated to 55% of adjusted profit after tax pre-IFRS 16. I'm not sure I love that. I think the money could potentially be put to better use, but I'll discuss that a bit more later. And they've completed a £15 million share buyback during the period. They've opened 5 new sites in the UK and 2 in Canada, and they're on track to reach 130 centres by 2035, 95 in the UK and 35 in Canada. The new sites and refurbishments are performing in line or above expectations, and they're now the largest branded operator in Canada, with significant growth since 2022. They have 3x the centres, 3.9x the revenue, and 3.75x the EBITDA. Canada now accounts for 15% of group revenues, and they're successfully replicating the UK operating model in Canada. For the outlook, they said over 70% of UK revenue is not subject to cost of goods inflation. Labour costs represent less than 20% of UK revenue, and UK energy is hedged through 2027. So in terms of that UK centre like-for-like revenue growth, as we mentioned, that was 1.1%, and that was driven by spend per game up 9.2% and a 7.5% decline in volumes. They basically put up the prices, and that's how that's been driven. And during the period, there were impairments of 2.3 million recognised, primarily in relation to the put-and-play mini-golf centres, which aren't really featured that much in the results because they are just a very small part of the business now. This is mainly a bowling story. And they've put a comment on the budget as well. So they've said the recently confirmed increases to the living and minimum wage were fully anticipated in our internal planning. However, the impact on our cost base will still be significant. In addition, the full year effect of the employer national insurance changes introduced in April 2025 will be in the first half of the 2026 financial year, creating a further step up in employment costs before any offsetting operational efficiencies take hold. On property costs, the government's business rates measures announced in the autumn budget offer limited respite. Although the lower multiplier is welcome, the shift to 3-year revaluation cycles introduced last year means that the April 2026 revaluation is likely to recalibrate rateable values upwards for much of our estate. As such, we expect the overall business rates cost to increase, with the benefit of lower multiple offset by higher valuations. And they've also recently come out with, on the investor relations page, they've got a slideshow basically about the opportunities in Canada, which I think, given it is such a big part of the growth story, is worth looking at. So they've said why Canada and why they've chosen to expand there. They said the reason is that the consumer leisure habits align with the UK. The sector is similar to UK bowling 10 years ago, where it's a fragmented landscape and it's low investment. Favourable competitive landscape. There's no significant branded chain operators. And they've said it's a low-risk stage 1 acquisition opportunity. So the Canadian properties have a cost of 17 million and the freehold value is 12 million Canadian dollars. So in terms of what they're on the hook for, it's probably only about 5 million, assuming they can recover that cost. They've got a brand and management team in place. Population of Canada is 42 million, which is 60% of the UK population. However, they are concentrated in a low number of key areas. Because of the extreme weather, Canada has very popular indoor leisure activities, and there are 180 plus bowling centres nationwide. However, the majority are independent operators. So their plan is to acquire or outpitch existing operators. So they're already the number one bowling operator in Canada with 15 centres, and they've got 371 lanes. And again, the number one in the UK with 77 centres and 1,719 lanes. So that 15, as mentioned in the results, planning to grow that to 35. And for that 77 in the UK, they're planning to grow that to 95 by 2035. They've identified 40 new greenfield locations in Canada. And as mentioned, they're targeting 35 centres by 2035. Based on that, there might actually be scope to expand further from there. But it's pretty obvious where the growth in this business is coming from. It's difficult because I think they're approaching Canada in quite a low-risk way in terms of the way they're building out the sites and stuff. But I just think where they're paying out quite a decent dividend, I'd possibly rather see them cutting that and just pumping it into Canada. But they are taking a cautious approach, which they're pretty open about. So I can kind of, I guess, see why they're doing it the way they're doing it. In terms of the valuation, the business trades at a PE of 12.8 and has a yield of 4.92%. I think that's pretty decent for what you're getting. I think there's a decent scope for increasing that revenue. It's obvious where it's coming from for the medium term. And I think it's possible they could even continue to grow it beyond that. And I think that yield's very, very attractive in the meantime whilst they're growing it. So yeah, I think it's a good little business. And I think that Canada expansion, when you think about it in terms of everyone being indoors because of the cold and everyone being concentrated together and it being quite a fragmented market, I think that makes total sense. And I think there is a clear opportunity there. Whereas before, you're kind of looking at it a couple of years ago when we first started covering it, and it was like, well, why have they picked Canada? That's a bit odd. But I think it does make a lot more sense now. John, what do you think about the business and the valuation?
Yeah, no, I think the valuation is pretty fair. Certainly not a commanding valuation. I think the more that we've covered it now, being a few times, I do get the investment case for the company more, and particularly with that move to Canada and why it makes sense. Obviously, management have been planning that and had the knowledge for a long time, but I do get it. I think with that, steady growth ahead, hopefully to continue in Canada, again, the valuation does look very reasonable. It's got a decent dividend. I would agree with you. If I were a shareholder, I'd probably rather forgo the dividend and see them invest more in Canada. I know that when we've talked about Hollywood Bowl, you do wonder about some of the opportunities, perhaps if they were to go into kind of the mini golf a bit more heavily. And you gave, I think, the example, Sam, before of junkyard golf, where they might serve cocktails and it's a bit more of a fun experience. It can appeal more to the adult market as well. So you'd have it going all the way from the younger market with Hollywood Bowl to the sort of, I suppose, young professionals and older adults in that kind of junkyard golf type experience. I think there is probably quite a lot to be optimistic about. And I guess management are doing it in that more cautious way. So it depends how you feel about that. I think you could certainly do a lot worse. If I were to be more bearish on it, I guess with that concentration largely in the bowling, if there is any sort of trend reversal there and it does fall from favour, then it's a big problem for them. Doesn't seem to be any sign of that particularly, and it's Tempe bowling has been in existence for a long, long time. So if you looked at past trends, whilst you can't bank on those, you'd think that actually there is a fair bit of resilience there. So yeah, probably not one that I'd be buying shares in. However, I think you could do a lot worse, and it will be interesting to see how Canada continues.
I think the junkyard golf one's interesting as well, because have you done Flight Club?
I have. So Sam, this is one of the reasons I haven't done any of these things basically since childhood with the Tempe bowling.
So Flight Club is like sort of social darts, and again, it's kind of, they've got darts games. It's like an electronic board, and they're serving cocktails and all that stuff. So it's quite similar. Which I don't know much about the put and play, which they've had the impairment for. It doesn't seem like it's been getting much focus, and I don't know if that is just traditional kind of crazy golf rather than sort of more of an adult junkyard Flight Club sort of thing. But yeah, you'd think that there is quite a lot of synergy there in terms of if they were to go out and try and acquire like a second UK brand, like a Flight Club or something like that, or Junkyard Golf. So I think Junkyard Golf has only got like 20 locations or something, so it would be of a size where I think they could actually swallow it up. But I guess for now, Canada's going to keep them busy anyway, so it's maybe somewhat of a moot point. But like you say, they are quite reliant on bowling.
Yeah.
But they're called Hollywood Bowl, so
Yes, that's right.
Fine. Should we move on to curries?
Yes, absolutely. So Currys is a business that we haven't covered in, I think, a couple of years now. For anybody who doesn't know, it's electronics retailer. They used to also be PC World, which was on the high street. They swallowed that up a couple of years before that. So it's essentially the combined entity there. And it's probably, I think I'm right in saying, the only listed electronics retailer in the UK now. I mean, previously you had Comet, and there were a number of others, including
We've got
PC.
AO, but that's just more white goods.
Yeah, okay, yeah, no, that's a fair point, but that's more online, isn't it, AO?
Yeah, it is. Yeah. I don't think they have any stores.
No, so I think with Currys, it's the only, as I say, I think I'm right in saying the only electronics retailer essentially on the high street, or more accurately, kind of in the retail parks. Anyway, as I say, we haven't covered it for a few years, but they had their half-year results out the other week, with the group announcing adjusted profit before tax of 22 million, which was up 144% year on year, free cash flow of 84 million, which was up 68% year on year, and the UK and Ireland, which is their main market, showing strong momentum with revenue growth of 6%, supported by share gains, 11% in service revenue, business-to-business sales of 16%, and new categories of 35%. It's also worth saying that they own a mobile network, which is ID Mobile, which is essentially piggybacked on the back of Vodafone and the 3 network, which subscribers grew 21% to 2.4 million. And Nordics revenue, so the two main divisions are the UK, which is about 61% of revenue, and then they have the Nordic division, which is 39%. So in the Nordics, the recovery was accelerating with revenue growth of 7% in currency neutral terms, and that was driven across most product categories. And they also announced a £50 million share buyback programme, and £30 million has been completed to date. Group revenue was 4.2 billion, which was 8% year-on-year growth, and driven by like-for-like revenue of 4%. In terms of the UK and Ireland like-for-like growth, that was 4%, and they comment on the government's increase in national insurance, which were not fully offset by cost savings and operational leverage. Nordics like-for-like revenue came up 4%. Current year outlook, they're commenting that group trading since the period end has been consistent with the board's expectations, and full year guidance is maintained, and the group continues to expect growth in profits and free cash flow for the year. And the longer term guidance, the group is expecting to continue the target of at least 3% adjusted EBITDA margin in both UK and Nordics. And in terms of valuation, Currys has a market cap of £1.33 billion and trades at 8.1 times forward earnings, compared with a 10-year average of 9.1, with a prospective dividend yield of 1.7%. I mean, I think it's an interesting company. It's basically the only tech hardware stroke electronics retailer left on the high street, and it's what the combined entity of Currys and PC, the old PC World, sort of became. Interesting that it's actually got quite a lot of exposure to the Nordics, and also that it's got the ID Mobile division, which is essentially a mobile network. It's not a company that I like. I think these results are very mixed, and they are adjusting for a lot of different things. And I think when you dig down, the numbers, certainly compared with the surface figures, are by no means as impressive. I think structurally, this is a business that is, in the longer term, in decline. I think with all of the sort of overheads that they have being a bricks and mortar retailer, it does make them incredibly hard to compete with the Amazons of this world. And I think it's very, very price sensitive. I suppose on this, one thing that they do have going for them is particularly some of the older customers who might actually like to go into store and have a bit of tuition and be talked through by a salesperson. That is something that they can offer, which the online retailers largely don't. But I think the number of people who will be looking and seeking that as we go through the years is probably fewer and fewer. And those silver surfers who might previously have liked that increasingly will be familiar with using all the online systems. And if they do want more tutorials, things like YouTube are freely available. So it's not one that I would be bullish on at all. I appreciate some of the numbers that they put up on the surface look half decent, but I think underlying this is not a good business and it's not one that I like. Sam, what are your thoughts?
I think the revenue growth is not amazing. I think the Nordics is disappointing. I know it says it gained market share, but I don't think Nordics was doing that well last time we covered it. Greek business is now gone. I think that was doing pretty poorly as well, so that's not going to be missed. But yeah, just such a tough industry. It does seem like they're in better shape, in fairness, but last time I think they were saying that they're talking about cutting the temperature of the stores by like 0.1 of a degree and stuff to save money, and it kind of tells you how tricky it is, and Amazon just doesn't have those problems. I think as well at the price, forward PE of 8.1, prospective yield 1.7%. I just think you can do a lot better at that price. So that business I'd really look at. I think you could do a lot better. So yeah, not for me.
Fine. Okay. On to our final company and one that you own.
Yes, it is. So I used to own it and then I sold it to buy a car and then I bought it back. So Wix, they're actually Israeli, but they're listed in the US. So they are a website builder. So basically help people build websites, and then there's lots of sort of monetization that comes from extra features and services and stuff like that they're able to offer. So Wix, they have come out with their Q3 results, and total revenue was up 14% to $505 million, and all these figures are in dollars. Creative subscriptions revenue was up 12%, and the annualized recurring revenue was up 11%. Business solutions revenue was up 18%, and transaction revenue was up 20%. Partners revenue was up 24%, and total bookings was up 14%. The total gross margin on a GAAP basis was 68%, and that's split by creative subscriptions, which was 83%, and business solutions, which was 32%. The net loss was 600 million, or 0.1 cents per basic and diluted share. However, the non-GAAP net income in the third quarter was 100.2 million, or $1.80 per basic share and $1.68 per diluted share. So the main difference between the GAAP and non-GAAP is the stock-based compensation, which we will cover a bit more later on. So net cash provided by operating activities was 128 million, while capital expenditure totaled 1.4 million, leading to total free cash flow of 127.3 million. Excluding acquisition-related costs, free cash flow was 32, or would have been 32% of revenue. In Q3, they repurchased 175 million of shares at a volume weighted average price of $136. Base 44 is quickly proving to be a top vibe coding platform with over 2 million users served and more than 1,000 new paying subscribers joining every day. So for anyone who doesn't know what Base 44 is, it's one of their new acquisitions, and it's an AI-powered app builder platform that enables users to create fully functional web applications using natural language prompts without requiring coding expertise. It automates back-end setup, including databases, authentication, and security features, while generating front-end interfaces and integration like payments or emails. And it uses AI generation from text descriptions, built-in hosting, custom domain, GitHub integration, and scalability for production apps, enterprise-grade security, and it suits beginners, solo founders, and developers for rapid prototyping, internal tools, dashboards, customer portals, or MVPs. Apps deploy instantly with full code access for customization and ownership retained by users. So I think this looks quite exciting. So they paid about 80 million in cash up front, and then there's an earn-out structure depending on performance, with targets running through to 2029, which have not been publicly disclosed. 80 million, that's on a company with a market cap of 5.6 billion, so pretty small, but I think it gives them a lot of optionality. I think it ties in very nicely with the existing business, and I think it just makes total sense. So that's quite interesting. Lior Shemesh, who's CFO, he said, with market share growing from low single digits to more than 10% since June, Base 44 top line growth is exceeding expectations. To capture this better than anticipated demand, we are accelerating our marketing investments in Base 44 with strong TROI. As a result of Base 44's outperformance, coupled with new cohort strength in our core Wix business, we are increasing our bookings guidance for the full year. I'm confident the strategic investments we're making today will enable Base 44 to be a meaningful growth driver for Wix in 2026 and beyond, with similar margins to our core business in the long term. In the outlook, they've said we're raising our full year bookings outlook to 13 to 14% compared to 11 to 13% previously. And this increase is driven by meaningful outperformance of Base 44. As a result, we expect Base 44 to achieve at least 50 million of annualized recurring revenue by year end, an increase from our previous plan. We expect total revenue in Q4 to be up 13 to 15%, and they expect non-GAAP gross margin to be 68 to 69% due to higher AI costs as a result of better anticipated demand and increasing usage volume for Base 44. Due to our anticipated increase in bookings, higher operating expenses, and continued working capital benefits, we now expect to generate free cash flow excluding acquisition expenses of approximately 600 million in 2025, or approximately 30% of revenue. That sounds pretty good. I think margins are going to drop slightly, but that's only because Base 44 is doing so well that they want to pump a load more money into it to make the most of the opportunity, which I've got no issue with. In terms of the increase, so if you take that figure of 600 million for the free cash flow, excluding acquisition costs, that would give them a price to free cash flow of about 10.5. However, the PE is 43. The reason for that difference, as mentioned earlier, is stock-based compensation. They pay out a lot of stock-based compensation, or they have historically. I don't know off the top of my head, but I've got a figure of about 7 to 8% a year for dilution historically. That is becoming less of an issue as the business grows bigger. And what is now happening is because they are churning out so much cash, they're using that to buy back stock. And that is now offsetting the dilution. So the share count is actually decreasing now. So, and I think that's something that's only going to grow as the business gets bigger. I think that free cash flow is still going to keep going up and up and up. And I think it's a business that's quite early on in its growth cycle still. So for me, I've not loved the dilution historically, but the growth has been very good. So I've kind of put up with it. I think now you're starting to see that shift for the first time where it's becoming less of an issue. I appreciate all the profits are being used to just keep your ownership proportion flat, and you're not really getting much of a return because the share count is only decreasing slightly. But I think what's going to happen is as the free cash flow increases, more and more can actually start being returned to shareholders. On top of that, you've got Base 44, which isn't something I'd kind of previously factored in. That's kind of become a bit of a nice surprise. But yeah, I think it all looks quite promising. I'm quite happy with it. And I think at that valuation, it's a pretty low risk play on AI as well. Even if Base 44 fails, you've got that core Wix business, which is not the most glamorous business in the world, but it does churn out a lot of cash. And I think going forward, very, very happy to hold it. Interestingly, the share price has taken a bit of a beating. So it's down about 50% in the past 12 months. I can't see anything that's really explaining it. I mean, there's some stuff like they've missed earnings a few quarters ago. There was a delay of a product launch. But I don't see anything major to me. I think it looks like a sentiment thing on first glance. But yeah, very, very happy at this valuation. It's probably worth mentioning as well. I didn't, although it's down 50%, that's kind of when it started dropping that I actually got back in. I think on my new position, I'm probably only down about, I think I'm down about 20% on it, which I've not got a huge issue with. What do you think, John, as someone who's more impartial?
Yeah, I think it's a difficult one. I think on the surface, definitely these numbers look good. It's an interesting acquisition with Base 44, and I do think logically it fits into, I guess, their portfolio. You can make websites, you can also make apps. I suppose one thing that I did wonder is that with the traditional website business that does bring in a lot of money, could that be disrupted by AI in the sense that you could have other platforms popping up which may be powered by, for example, ChatGPT, OpenAI, and essentially have a very straightforward website builder that produces professional looking websites very similar to Wix, which then significantly disrupts the core of the Wix business model? That's the only thing. And I'm not a computer person. I don't know how far away, if it is possible, for something like that to come along. But would that, affect your, I suppose, thesis for Wix?
So in short, yes, I think it would.
Yeah.
However, there's already like alternative apps that are meant to make it really easy to. So they're obviously in a very competitive field anyway. You've got apps like Squarespace and stuff like that. I think AI is just going to be like another version of that. I think the hope is that Base 44, if they make the investment in that, firstly, the cohorts they've already got. So what they do is they group their customers into cohorts. So if you start your website in 2014, you're in the 2014 cohort. And then what they'll do is they'll map out kind of the expected sort of revenue they expect from you over your lifetime, and they will measure each cohort separately. So I think even if they just retain the cohorts they've got, they're priced to do very, very well.
Okay.
I think if Base 44 does well, and that's giving you nice optional add-ons and stuff for the AI generation, you've probably got no reason to leave, because it's probably a bit of a faff.
Yeah.
And as long as Base 44 works well, those existing cohorts aren't going to go anywhere, which I think is the main thing. It sounds very encouraging for Base 44. It's not a field I really know anything about, to be honest, in terms of the AI. It wasn't really part of the thesis when I originally bought it. The hope, I guess, would be that Base 44 it becomes what Wix is for the AI stuff, assuming the AI stuff gets to a point where it's reliable. Because at the minute, I don't actually think it's as good as people think it is. Like, my girlfriend works in data analytics, and she's got a lot of colleagues where they'll use AI for stuff, and it just doesn't work properly. And you can just tell by looking at it straight away that they've used AI. And what she's finding is, at the minute, the people who are using the AI is the people who just aren't very good at coding. And then the problem is, if something goes wrong, they just can't deal with it because they're just totally dependent on the AI. So I think it's still got a long way to go, but hopefully with Base 44, they've positioned themselves as well for it as they can. But yeah, it is a risk. But then at 10.5 times free cash flow for a decent AI play, I think it's, for me, it's an acceptable risk, I guess. So with that in mind, then, of the 6 businesses we've covered this week, British American Tobacco, Moonpig, Carnival, Hollywood Bowl, Currys, and Wix, which do you like the most and which do you like the least?
I would say I'd go for Moonpig as my pick this week. Hollywood Bowl, I think, is certainly an interesting one, but I would go for Moonpig. And last, gosh, that is tricky. I'd probably go for Carnival on the basis of the industry, but equally, I really don't like Currys.
So I think my favourite would probably be Wix. I'll exclude it because I'm biased and I already own it. So if out of the others, it would be Moonpig, I think. Least favourite's quite easy. I think Carnival's just uninvestable because of the industry. I think Currys, in fairness, is also uninvestable, but I think Carnival is actually more uninvestable because of the debt, and I think the industry is actually worse.
Yeah.
It's like an airline on the sea, isn't it, really?
It is a bit.
So yeah, not for me.
Fine. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.